This is video 1 of 2 videos on preparing a statement of affairs. Statement of affairs is done based on Form 507, which is available on ASIC's website, and it's prepared by the liquidator to estimate the realizable value of a company's assets and to assess whether there will be any surplus or deficit on liquidation. So it's basically a document that we draw, the liquidator draws up at the start of the process when a company is in the process of winding up, and to get an idea of whether there will be sufficient funds to actually distribute any money back to the shareholders once all the creditor claims have been settled. So in this first video clip, I'm just going to look at the first section, and that is dealing with the assets of the company up to the first secured creditors. Now, the purpose of the statement of affairs, as mentioned, is first of all to see what can be realized. So that's why we start off with looking at the assets of the company. And then we need to consider who needs to be paid, because the creditors' claims are settled first before any distribution is made to the shareholders. So what's important is that you know the order of priority of creditors, so that you know in which order to rank them when we start settling their claims. Now, if you look at the question 2114, and I'm going to use that to draw up a statement of affairs, you were given the company's statement of financial position. Now, as I mentioned, we basically deal with 3 things in the statement of affairs. First of all, we have a look at the assets of the company to see what is the estimated realizable value from selling off those assets that we all pool together in a pool of funds that we can then use to honor the claims of creditors. So we'll then look at the creditor claims. And once all those claims have been dealt with, we know whether we'll have a deficit, so not enough money to make any distribution to the shareholders, or only a partial distribution, or whether there's a surplus, meaning there's extra money that can be returned back to the owners of the company. So if the first part of the statement is to look at the realization of the assets, of course we have to start off by identifying those assets from the statement of financial position. So you've got a summary there. You see they've got land and buildings, plant, some inventory, bills receivable, accounts receivable, and cash on hand. Perhaps also just cast your eye, but up to the top you'll see there's been ordinary shares issued, called to 75 cents. So there's calls and arrears of 25 cents. Now, that's not listed as an asset, but it is a receivable by the company, and if we manage to get some of those calls and arrears, that money can be used in settling the claims of the creditors. However, these assets are recorded at their carrying amounts in the statement of financial positions, and the carrying amounts not necessarily a reflection of what we can get for those assets if we sell them. Now, of course, if a company is in liquidation, they're more desperate to get rid of the assets, so we might see that the realizable values will be less than what the assets are recorded at in the accounting records. One other thing we need to consider before I look at the estimated values given in the additional information is whether any of these assets served as security for a debt of the company. Now, the reason why that is important is that the assets that have been given as security for debt needs to, any funds that we realize from selling of those assets should first of all be used to settle that original debt. If there's excess money available, that can be included in the fund of pools, or the pool of funds that we use to settle the rest of the creditor claims. So let's look at our liability section, and you'll see we first of all have our normal business creditors. Then we've got bank overdraft secured by a floating charge. Now, all that means is that bank overdraft is going to rank higher than these poor guys that has no security for their debt, because the bank overdraft has a general claim on the assets of the company. So no specific asset has been given, but they've got a floating charge over the assets of the company. We then have two other creditors here, a mortgage payable, which is secured by freehold. So the mortgage and the freehold land and buildings, they link directly together. So any money that we get from realizing the land and buildings will first of all be used to settle the mortgage amount that is due. And if there's any excess money available, that will be made available to the rest of the creditor claims. If we don't manage to settle the full mortgage debt that is due, so if we don't manage to sell the assets for at least $45,000, that extra claim will serve with after the other unsecured creditors, but I'll refer to that again. The other one that we need to pay attention to is the partly secured creditor. So they've got a $5,000 security on a specific piece of plant. We still owe them $8,000. So when we look at the realization of the plant, we need to remember that a portion of that serves as security, specifically as security for this creditor. So he's going to have a preferential claim on the realization of the plant. Okay, so now we can have a look at the additional information. So it's estimated that 1,000 of the calls and arrears will be received. So of this receivable of 1,250, we estimate to realize 1,000. And from the other assets, we were then given the estimated sales values. Okay, so let's use this information and start drawing up our statement of affairs. As I've mentioned, the statement of affairs, the format for this document is prescribed in Form 507, which is available from ASIC's website. For your purposes, you need to just know the order of dealing with the items in this form, because if you know the order, and you need to know the order in order to do any question on liquidations, you will then be able to list the items in the correct order. So I'm just in this video clip looking at this first section of recording all the assets that it's not specifically given as security. And I'm also going to look at the assets that were specifically given as security for a debt. So what we do is we first of all list any interest in land. Now we don't have any in this question, which is not given as a security to a creditor. Then our sundry debtors, in our valuation column, we see the carrying amount of the assets, so we get the value from the accounting records. And then in the estimated realizable value column, that is what the liquidator expects to realize the assets for. So accounts receivable of the 15,500 on the books, we expect to get 11,000 in when those debts are settled. Bills receivable should realize for the carrying amount. Calls and arrears, we mentioned that it's a receivable where we'll expect to get 1,000 of the 1,250. Cash on hand, of course, the realizable value will be the same as the accounting records. Then inventory, we've got 34,000 on the books. We expect to realize the inventory for 29,000. There's no work in progress. So that brings us to the plant and equipment. Now, plant and equipment had a book value of 2,500, but that included $5,000 that were partly or given as security for part of a debt. So in terms of unsecured or assets not given as security, there's a balance of 7,500 in terms of the carrying amounts. We estimate to realize the plant and equipment for 10,000, which includes 5,000 relating to the plant that were given as security. So with regards to the plant that weren't given as security, we estimate to realize 5,000. Okay, so this total then starts off the calculation, and it gives us our first indication of funds available to settle creditor claims. The second heading that we see in this form is assets subject to specific charges. And you know that they are one of the first creditors to have a claim on any funds available. It's the creditors with a claim to a secure or specific asset. So in this case, freehold land and buildings were given as security for the mortgage. So either the mortgage holder can take possession of the land and buildings and sell it off to the best or the highest value, and if there's any money left after his claim has been settled, he'll return the money to the liquidator to include in the pool of funds for distribution to other claims. The alternative is the liquidator sells of that asset, settles the mortgage holder's claim, and retain any excess money. Now, in this example, the freehold land and building had a carrying amount of $57,000 and a mortgage outstanding of $45,000 in the accounting records. So the net position is that we expect an excess of $12,000 from realizing the assets and then settling the claim. However, the asset was sold off for, or potentially for, $60,000. So our estimated realizable value is not the $12,000, but $60,000 less the claim of the mortgage holder. So that's $15,000. And that extra money, of course, as mentioned, will be included in the pool of funds for settling the rest of the creditor claims. The more tricky one in this question is the plant. So the plant has been given, or a portion of the plant has been given as security, and the portion that has been given as security is $5,000 worth of plant. So the secured creditor has a claim actually of not $5,000 but $8,000. But in terms of what he can claim with regards to the security that was given for this loan, or the credit that was extended to the company, was to the value of $5,000. So he's going to have an excess claim higher than the security that was provided for the debt of $3,000, but that's not going to serve here as part of our assets subject to specific charges, or our creditors with a specific claim. That's going to rank after the unsecured creditors. Okay, so the $5,000 claim is ranked at this first phase of the calculation up to the value of the security given for that creditor. So there's no, at this stage, no extra money that is made available to the liquidation process. Now, as you can see, this is a running total here at the end, so we keep on calculating new totals after each heading or section. So at this stage, our total estimated realizable value from selling off the assets will be $66,000. So that is what the funds we expect to have available to settle the claims of other creditors, as well as for distribution to the shareholders.